So Marty, yeah, just to introduce myself, my name is Thomas Barron. I run a family office out of the APAC region, headquartered in New Zealand, Auckland. We run an investment fund based on global equities. So if you could, I'm turning on. Okay. So we have a pretty stringent methodology in how we pursue our investment philosophy. So we only go into public listed companies on a global stage. So if you can move to the next, yeah. So we're an active manager who offers a unit trust offering over a diversified portfolio of global assets. We deliver constant risk-adjusted returns using strategies across global markets. And we have a derivative book. So we have a technical derivative book and a strategic derivative book. So the technical derivative book is from 0 to 20 days. So it's normally we take opportunity of market changes. And the strategic book is between 3 and 6 months. And the strategic book effectively is like a cover, like an insurance cover for a strong market drawdown. So let's say the S&P would go down, S&P 500 would go down 1,000 points. Then we would participate on the downfall, on the downside, and effectively cover the portfolio. So there would be very little negative impact on the portfolio. All right. Can you go to the next slide? So let's talk about what happened last week in China. So China had a military parade to commemorate the 80th anniversary of World War II, and they also had the Shanghai Cooperation Operation Summit in Tianjin. So it was a combined event effectively. So you can see here, so they have intercontinental ballistic nuclear weapons. You see on the right-hand side, that's their latest lasers, which are the most powerful they have. And then they have underwater drones and land drones. They had some other hypersonic missile weapons and stuff, which I haven't shown here, but it was quite an impressive event. So I would suggest if you have the time, go to YouTube and have a look at just how perfect it was inscenated. It was actually an amazing show. So if you can just go to the next slide. So here you can see after the parade, I mean, the leaders were meeting. So you can see Vladimir Putin here, Xi and Kim Jong-un. So they were looking at the parade. The interesting part was that actually Narendra Modi, he wasn't actually at the parade. So they met at the side of the Shanghai Cooperation Operation Summit. So you can see here Putin and Xi meeting with Modi at the sidelines of the summit. So that was quite interesting. Could you just move to the next slide, please? Okay, just to give you a little bit of a comprehension of what actually happens on the other side from the world. I mean, we are in Asia Pacific, Australia, New Zealand, we are closer to China and probably have a little bit more an understanding of what happens there. So just to give you an idea, let's see what the land looks like. So you have China, Russia, and North Korea, and India making roughly around 19–20% of the total land mass of the world, which is around 150 million square kilometers. Then you have the US, Europe, Canada, Europe and Australia and New Zealand, which make up roughly the same amount. So you have effectively two players. You have one in the east, which makes up of the land mass, and then you have the West effectively. Now, looking at the population, it looks slightly different. So if you look at US, Europe, and Australia, you only have probably around 13.8% of the total world population. And then you look at China, Russia, and North Korea. I mean, North Korea, it's the same amount as Australia. It's almost can neglect that. And India have 1.4 billion. So they make up 37% of the total world population. All right. So if you can go to the next slide. Okay. Now we just want to have a look, because the US obviously is the biggest economic power in the world, makes up, in US dollar terms, makes up around 30 trillion of GDP. Then Europe is slightly smaller, and then Australia. So the total GDP of the Western world is around 44%. And then if you look on the US dollar basis, you have China, you have North Korea, and you have India, and they're making up effectively less than 25%. But if you look at the GDP level, at the purchase price comparison, then you can see that the US still has $30 trillion. But on the purchase price level, the China actually has a higher GDP. And then the same with Russia. So China has almost double the GDP on the purchase price parity. Russia has almost 3 times more on the purchase price parity. And North Korea 3 times, and India the same. So if you look at it from a purchase price parity comparison, you have effectively roughly 30% on the western side and 30% on the eastern side. So why is that so important? Well, let's find out on the next page. So here you can see the military spending over the last 10 years up to 2023. I think now it's almost $1 trillion for the US in US dollar terms. So the US spent in 23, 916 billion. China was 296 billion, and Russia 170 billion. Now the issue is, I have excluded India there because we see India effectively as a swing state, because we think that India will still export as much to the US as before. The only...
So keep on talking into your thing.
Can you hear me?
I think they should be able to hear you. Can you hear it now, guys? They can hear now. So speak up.
Right. So how do we see kind of bipolar world between East and West?
Give me your laptop, put it here, and you're gonna run it. They can hear you through the speaker.
Okay. Okay. All right. Let's go to the next page. How do you go?
Just hit the down arrow. Ready?
Okay. Right. So how are we going to invest in this VUCA world? So we have a very diversified portfolio across regions. So we actually focusing on fundamentals of the company. So our portfolio is roughly spread evenly across the world. We have a focus on Asia Pacific a little bit. So we probably 40-50% focused on Australasia and Asia. We have about 25-30% in the US. Yeah. So what do we look at? We look at resilient sectors like industries which are less affected by tariffs, benefiting from shifts such as technology, renewable energy, and commodities like precious metals. We monitor closely the geopolitical developments. So we're keeping on top of what's happening in the world.
We have a flexible investment mandate, so we always have around 20% cash liquidity. We have a flexible mandate of how we can invest, but we're not investing in private credit and private equity purely due to the liquidity, and we are long-term focused. Here you can see of what our portfolio looks like. We have in the US and Canada, we have around 28%. In most of the investments in Canada are in mining stocks. In the US, we have Rocket Lab, Life 360, iRhythm, which are small mid-tech, mid-tech companies. And then we have Aussie and New Zealand bonds. That's effectively our cash position because we can draw down on those within 5 working days and can invest or recycle them into shares. Our technical and strategic derivatives we talked about. So the technical derivatives, I will show you what the performance of those are later. The strategic derivatives are effectively to cover the portfolio in a strong drawdown. So let's say the S&P 500 would go down 500 or 1,000 points. That's when we would take part in the drawdown and would actually generate profits. So here can you see what we did over the last year? It's actually looks better. So the year is not over yet. But our bond portfolio does return around 8% net per annum. Our normal shares globally have probably slightly better, they're around 20%. The mining sector, which is most of it investments in Canada, Australia, and South Africa, we actually did phenomenal well so far this year. So we're 50% up. And then our trading results for year to date is around 55%. So this is just a glance of some of our holdings. So Life 360 is a global safety app, which has around 90 million active users, and that has gone up 40.
Keep on going.
That has gone up 40% over the last 3 months. iRhythm is a healthcare company focused on developing, commercializing wearable biosensing data analytics. And they have gone up 19% over the last 3 months. And then Kinross is one of our bigger gold mining holdings. They're operating out of Canada. Over the last 2 years, we did around 160%. And over the last 3 months, they did 45%. Right. So that's our trading performance on the online platform. So the tactical trading happens online. The strategic trading is normally via a broker where we trade futures up to 6 months. So here is a new addition to our portfolio in the mining sector. It's a gold miner called Ramelius Resources. So we started buying into that miner early July. And
I'll take that back. And then you turn off the sound.
okay.
All right.
All right.
Do you have the deck here?
Okay, we can see here. So we bought slowly into it at $1.30, or it's €1.30. So we're trading that out of Europe, and it has gone up to €1.90 over the last 3 months. So we did pretty well there. Next slide. Yeah, so what we're looking at the moment, we're looking at a lot of silver miners. We have a reasonable amount of silver miners in the portfolio, but what we're seeing at the moment is gold has gone up to almost $3,700, and silver has moved from April $30 now to around $41, $42. So during the last 8-9 months, or 6 months, it actually has gone up 30–40%. So it's trading around 90 times to 1 to gold, and we quite confident that probably by end of 2026, 2027, we probably trade around 50 times gold. So we're positive that silver is probably going somewhere to $60 to $80 over the next 2–3 years. And that's when the silver miners really will kick in. So we have a couple of junior miners we're looking at the moment in Canada, which are still quite cheap. Most of the other silver miners we have, like First Majestic Silver or Pan American Silver, they have already had a good run, but I think there's more to come.
Are you buying these mining stocks via directly or via an ETF or?
No, we're buying the mining stock directly. So we do the research on the mining stocks, and Okay. Next. All right. So that would be an example of how we think the next 5 years would probably look like for us. So this year we're probably doing around 26%. I have put in 16% because just over the last months, the mining sector has really blown out the lights, really. So we did really well on that side, and have effectively have recycled out of our bond holdings into mining. And we do have a feeling, considering we see a lot of buying out of China at the moment into gold ETFs. So that there's definitely a lot of demand out of China into gold. And then if you look at the central banks, how much gold they are buying at the moment, we have more gold in treasury than foreign exchange. So from that perspective, we're quite positive. From our perspective, the central banks are actually preparing for a currency reset. So
more gold is being held by central banks than dollars right now.
And we're quite confident that the currency reset will happen. It's just a matter of time when it's going to happen. It's not if.
But by reset, do you mean a dollar crash or a very slow dollar downtrend?
That's a very good question, because the crash on the currencies could actually come from a different area. It could, like a country like France going down, or the UK.
How does that impact the dollar?
It could be a systemic risk. It could cause a crash worldwide. So if the IMF could not bail out the UK or France, so what's going to happen? They're gone bankrupt. So it could have a domino effect,
I guess we've been living in a world of concerted central bank efforts since 2008.
Yeah. But the thing is, I'm not saying it could be a dollar crash, but it could. A global currency reset, like a Bretton Woods, could happen because one or two countries fall at the same time and nobody can pick it up. And then you would have a Bretton Woods, and it would have like some kind of currency reset. I mean, why would all the central banks buying so much gold at the moment? They sold the gold 20 years ago, and now they keep buying gold at a much higher price. The only reason for that is that they're preparing for a global currency reset.
Okay, I'll keep on going.
Oh,
I'm not arguing with you. I'm just testing your argument.
Okay. So we have seen the performance of if we would have a smooth sailing over the next 5 years, or like we would say the S&P or the stock market would go down 25%. So in this case, our strategic derivatives would actually kick in and would cover some of the losses. The technical derivatives, they normally produce between 55 and 70% per annum. And we should be able to still return around 6–7%. That's based on the fact that the gold mine or the silver mining stocks don't go down as much as the other equity. What we did learn during the April drawdown was that when the drawdown is sharp, effectively, you have a liquidation of old assets because there will be margin calls. Right. Okay. So then
Let's
it just look back.
fireside.
Okay, so the strategic derivatives would have recovered some of the losses, then you would still do about between 0 and 6% upside. And then we would recycle the strategic derivatives back into equities, and then the growth rate would come back to around 16 to 20% per annum. All right, so we're trying to raise around 50 million US to set up a wholesale fund. So yeah, if you're interested, yeah, give me a call or send me an email, and I'm happy to sit down with you after the during the dinner. Okay.
You will be at dinner, so that's
Yeah.
great. And how much are you managing right now?
It's about 8 million.
8 million. Okay. And that's organized. That's like the equivalent of the US RIA.
So that's run as a family trust, but the wholesale fund. Yeah.
I'm sorry.
So it would be run as a unit trust fund.
Got it. Okay, great. So it's very interesting. I mean, I don't think, and Camille, obviously, there's many of us here who come from other countries, right? And we know this song. We've heard it before of, you know, things changing, right? I don't know if I'm prone to Fortress US or what. Maybe that's part of my problem. I think the US is kind of, you know, has barriers around it because it's one of the few self-sufficient countries. But I see a lot of problems in Europe as a result of.
Let's ignore the problems in Europe at the moment. The thing is, I think China is building a clear alliance, well, with Russia anyway, but they're building clear alliance with other countries around them and effectively building a very big bloc. You know, they're building, or during the summit, they have met with the Prime Minister of Mongolia. They have effectively signed off on the Siberia 2 pipeline. They're just, I think the only discussions at the moment is around the price for the gas. Then, yeah.
Maybe Deepinder was the head of Pakistan also at the same event?
Pakistan was there as well.
Which is unheard of. But I think there's a question, so let me just get the microphone over to Camille.
Thank you, Marty. Thank you. Look, I don't want to be misunderstood that the dominance of the dollar is not going anywhere. The dominance of the US dollar is not going anywhere. But
again, 80% of all corporate bonds that are foreign are in dollars.
Till today. You are absolutely right. The only thing that is changing is when you went like this, there is a sentiment today that are the G8 and the G11 capable of paying back their debt, and how are they going to solve it?
Well, and the remarkable thing about the European Union is that it was founded to be based on solid money, and they've blown through every barrier boundary they had. Right?
I mean, the presentation was not about the presentation with the US dollar was not about that the US dollar is pressured. The issue was more around that Russia and China on a purchase price parity are spending the same amount on defense.
That's one part of it. Yeah.
Yeah.
So it's an undermining of U.S. dominance.
Oh, it's not undermining the dominance. It's different. Well, it's probably pulling up a wall of U.S. dominance or U.S. influence in the Pacific Rim.
I agree with that.
Foreign investors today are observing that the G8, G11 countries have the slowest GDP growth. So they are looking more into alternative markets, not necessarily emerging or premier alternatives. They're looking for today regional countries investments, meaning creating coalitions in between countries, putting supplying industries over there in order to fight back the tariff and at the same time fight back the dominance of you lending me to control me.
Of course, right. I mean, and Jeffrey Sachs has a great YouTube channel. Everybody overseas, Jeffrey Sachs.
My favorite hero.
Thank you. Right. A lot of people agree here, right? But anybody who's from a country that's been under IMF or World Bank dominance understands that it's not a solution, but it's a it's like morphine, right? But yeah, so understood. And so you're saying the pathway forward is gold, commodities, mining. That's a pathway.
It's part of the portfolio. It's not all of it. So we do think that mid-tech companies. We have some companies in China, which are global companies in gaming and stuff like that. So we do think some of the software companies can be global without being impeded by tariffs. Then some of the companies we think like India will be the next big play for us, especially around, if you look at their population, you know, the average age of India is 29, 40% are under 25. So you have a very long runway of growth, and you know, they're doing 6-7%. I mean, I do understand that the growth in China is slowing down. I mean, or has slowed down, but I still think it's a positive growth at around 3%, 4%. So we're still positive around Alibaba, Tencent, Trip.com. Yeah. So we're still quite positive about China, not necessarily in the real estate sector where we are not in. Yeah.
Any questions from the audience? Any other perspectives? Tom, great job. Thanks so much.
Okay. Thanks very much.
We're going to call that a day. We're starting back tomorrow at 9:30. I've got this great speaker who's done a lot of TED conferences, and he thinks tariffs are bad, and he's anti-US, which is great to hear. And so please tune in at 9:45 for George's Uge. I think that's a correct pronunciation. Otherwise, thanks so much for dialing today, and we're going to head to dinner in a little bit. Thanks.